Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 26th session. Last day I have discussed on short and long straddle. Today I will discuss short and long strangle. Before we start, I will solve a problem of short straddle. Problem: fund manager anticipates that a big move in the stock of ABC Limited. Anup of XYZ fund believes such change will be upward, while Sham of PQR funds holds the opposite view, that is, moves downward. From the following information of ABC Limited, explain what action will Anup and Sham take and why. Given data, exercise price is rupees 100, premium of call option is 15 and premium for put option is rupees 10. Since Anup anticipates the market moves upward significantly, so his strategy will be to buy 2 call option and 1 put option at the same strike price of rupees 100. And maximum loss will be total premium paid, that is equal to 2 into 15. 2 is the call option and 15 is the premium paid for per option, and 1 into 10 for put option is equal to 40. Now you come the diagram, you see that this is rupees 100 the strike price. When the spot price reaches the strike price, that is ATM, then the trader will incur a maximum loss of rupees 40. The strategy will be buy 2 calls at strike price rupees 100 and premium is 15 into 2 is equal to rupees 30, and buy 1 put option at strike price rupees 100, premium is rupees 10. Maximum loss I have discussed, that is premium paid 30 plus 10 is equal to rupees 40. Higher BEP is equal to 100 strike price plus 40 by 2. 40 is the premium, total premium paid by 2. But 2 is the call option buyers, that is 120. And lower BEP is equal to 100 minus 40 is equal to 60. When market price moves upward and exceeds the BEP in bullish side, the fund manager will earn profit as he anticipated. Come to the table. Current market price. Now strategy is buying 2 call at ATM strike price rupees 100. And premium is 2 into 15 rupees 30, and buy 1 ATM put option, strike price is rupees 100 and premium is rupees 10. Now up to the point of 100, that is strike price, for call option, for call buyer, he incurs a loss of rupees 30, that is the premium paid. He will not exercise his right and he will incur loss of premium paid rupees 30, and it comes from the lower side to upper side, that because it is call, long call, and for long put the maximum loss will be the premium. He will incur the loss of rupees 10 up to the point of 100 the strike price, and at this point the buyer of the strategy will incur a loss, suffer a loss of maximum loss of rupees 40. And from this point, if the market moves downward or move upward, the loss will decrease gradually, and up to the point of BEP it becomes 0. And after that BEP, if the market moves in either direction, the option buyer, the strategy will goes into profit zone and profit will start. Since Anup is anticipates that the market moves upward, so we'll concentrate on the bullish side. Now for 100, the BP maximum loss is rupees 40. Then when market moves upward 110, that is 2 into 10, that is 110 minus 100, that is 10 is the gain for call option. For 2 call option, it is 2 into 10 minus 30 is equal to minus 10. Here it is minus 10. So the loss comes down to 20 from 40. Next 120. Here it is BP. 2 into 20, 120 minus 100, that is 20 into 2 minus 30 is equal to 10. Here it is minus 10, the BP attained. And in the spot price becomes 130, the profit will be 20. And it is 140, the profit will be 40. Gradually, the profit is increasing. The 150, the profit will be 60. The profit trends is upward. Reasons in buying 2 call option when market is anticipated bullish. Number 1, BEP is much lower in 2 call option than single call option, that is 120 for 2 call option and 125 is the single call option. So the trader will reach BEP earlier in 2 call option than single call option. So he has in an advantageous position to earn profit earlier. The next point is profit in buying 2 call option is much higher than that buying of single call option. When market moves upward and going beyond BEP, which is shown in the following table. In the table I compared the 2 strategy. One is buying 2 call option at the strike price of rupees 100 and premium 30, and 1 put option and strike price is 100 and premium is 10. And another strategy is buying 1 call option, strike price is 100, premium is 15, and 1 put option, strike price is 100 and premium is 10. Here we start with the break-even point. For 2 call option, 120 is the break-even point, that is 2 into 20 minus 30, it will be positive 10. Here it is minus 10, so BEP point reached. And 130, if it market moves upward, the profit will be 20. For 140, the profit will be 40, and 150, the profit will be 60. Come to the single call buyer, that is one for 125, the BEP point reach, that is 1 into 25 minus 15 is equal to 10, minus 10 is equal to 0. Net return will be 0. For 130, the profit will be 5. If you compare it with 130 for 2 call option, here you see that the profit is 20. Here it is 5. So much higher profit the buyer will gain. And for 140, the profit is 15, and 150, the profit is 25 for single call option. So you compare these two, you see the profit in the 2 call option buyer is much higher than the single call option buyer. Since Sham anticipates the market moves downward significantly, so his strategy will be to buy 2 put option and 1 call option at the same strike price of rupees 100, and maximum loss will be total premium paid, that is equal to 1 into 15 plus 2 into 10 is equal to rupees 35. Higher BEP is 100 plus 35 is 135, and lower BEP 100 minus 35 by 2, that is because he buys 2 put option. So the lower BEP is 82.5. You see, this is the strike price 100. When the spot price reaches 100, the trader will suffer a loss of maximum loss of rupees 35. And if it moves downward or upward, the loss will decrease gradually up to the point of BEP. After that, it reaches the profit zone. And this is the BEP point 82.5, and this is the lower BEP point, and higher BEP point is 135. Come to the table. Current market price. One long ATM call strike price is rupees 100 and premium is 15. Here 2 put option strike price is 100, premium is 20. So for 50, the net return is 65. You first start with the strike price, that is 100. The loss will be the highest, minus 15 minus 20 is equal to minus 35. Now we concentrate on the bearish side because Sham anticipates that market moves downwards. So when it moves to 90, the loss comes down to minus 15 because minus 15 in the call option and 2 into 10, that is equal to the profit is 100 minus 90 is equal to 10, multiplied with 2 because 2 put option he buys, minus 20 is equal to 0. So net return will be minus 15. The loss will decrease from maximum loss 35 to minus 15. And now in the break-even point it becomes 0. Break-even point reach at 82.5. Spot price when reach 82.5, then break-even point reach, that's equal to minus 15. Here 17.5 means 100 minus 82.5 is equal to 17.5 into 2 minus 20 is equal to 15. That is break-even point. If it comes down from break-even point, say 80, the profit will be 5. Next 70, the profit will be 25. And 60, the profit will be 45. And for 50, the profit will be 65. Reasons in buying 2 put option when market is anticipated bearish. BEP is much higher in buying 2 put option than single put option. That is equal to minus 82.5 minus 75. In negative side, 82.5 is much higher than the 75. So the trader has the advantage to reach by BEP in 2 put option earlier than the single put option. So next point is profit in buying 2 put option is much higher than that of buying of single put option when market moves downward and falls below BEP. Here the table where I compare these 2 strategy. One is buying 1 ATM call, strike price is 100, premium is 15, and 2 put option, strike price is 100 and premium is 20. So start with break-even point 82.5, here minus 15, here 2 into 17.5 minus 20 is equal to 15. So it is 0. Break-even point reached at 82.5. When it comes down to 70, then the profit will be 25. When it comes down to 60, then the profit will be 45. At 50, the profit will be 65. the profit trends is upward, and 40 the profit will be 85. Now come single put option strategy, that is buying one call option at ATM strike price 100 and premium is 15, and one put option, the strike price is 100 and premium is 10. Start with the break-even point, that is 75. Here it is 85.2, here it is 75, minus 15. 1 into 25 minus 10 is equal to 15. The break-even point attained at the point of 75. Now it comes down to 60, then profit will be 15, where at the point of 60 in two put option buying strategy, the profit is 45. Here it is 15. Now 50, the profit is 25, and here it is 65. And for 40, the profit will be 35, and here it is 85. So if you compare the profit of two put option, you will see that profit is much higher than the single put option buying. Next come Strangle. Strangle is an investment method in which investor holds a call option and a put option with same maturity but has different strike price. In Straddle, it has same strike price, but in Strangle, it has different strike price. There are two types of Strangle. One is short Strangle and other is long Strangle. When both the call and put are sold, the strategy is known as short Strangle, and when the trader buys both call and put option, the strategy is known as long Strangle. In short Strangle, if the price of the stock does not change considerably, that is both option expires worthless, where it arises when the buyer of the call option and put option will not exercise his right, then the both option expires worthless. Then the investor gain the maximum profit, which is the summation of two premium received. Short Strangle, how investors sell call option with strike price higher than the stock price, that is OTM, out of the money, OTM call strike, and sell put option with strike price lower than the current share price, that is OTM put strike, for same maturity. Here the trader will earn maximum return when the underlying price hovers between the range of the two strike prices, that is remains within the ranges, that is lower strike price and higher strike price. The maximum profit will be the summation of two premiums. When the market breaks it either to bullish side or bearish side, the risk will start and return will decline continuously up to BEP, where it comes to zero, and after that the trader will suffer losses which may be extended to unlimited. There are two BEP. One is lower BEP, which is lower strike price minus total premium received, and other is higher BEP, which is higher strike price plus total premium received. Now come to the diagram. You see the spot price is 3000 and the strategy is sell one OTM call. Strike price is 3100, which is higher than the spot price, and premium receivable is rupees 125. and sell one OTM put strike price. The strike price is rupees 2,900, which is lower than the spot price. The premium receivable will be rupees 110. The total premium receivable is 125 plus 110 is equal to 235. Maximum profit total premium received is equal to rupees 235. You see, the lower strike price is 2900 and upper strike price is 3100, and with this range the maximum profit will earn by the trader, because when the spot price hovers between these two range, they will attain the maximum profit. And from this point of the lower strike price or higher strike price, if the market breaks in either direction, that is comes down or goes up, then the profit will reduces gradually up to the point of BEP, and when it crosses the BEP, the loss will start and it will go up to the unlimited level. And here ATM is 3000. ATM, the spot price is this. ATM is in the midpoint of 2900 and 3001. So it will be here. The point is there. If you extend this point to meet this point, so it will be the straddle. The profit of the straddle is higher than the short straddle, is higher than the short strangle, because the premium receivable is higher because it is 18. In OTM it is less than 18. Maximum loss could be unlimited if price move either direction. Higher BEP, higher strike price plus net premium received, that is equal to 3100 plus 235 is equal to 3335. So this is higher strike price 3100 plus total premium received, it will be the higher BEP, that is 3335, and it is lower BEP means lower strike price is 2900 minus 235, the premium received, it will be 2665. Come to table. Short strangle, spot price is 3000, current market price. Now short call option, strike price is 3100, which is higher than the spot price, and premium is 125. Here short put option, strike price is 2900 and premium is 110. Up to the strike price 3100, the option trader will earn a profit of 125, that is premium receipt, as because the call buyer will not exercise his right up to the point of 3100. And for put option, up to the strike price of 2900, the seller will earn a profit of rupees 110, the premium receipt, up to the point of 2900. So in this region 2900 to 3100, the profit will be maximum 2035 and 2035. And when it breaks in either side, say the market moves downward, then the profit decreases gradually up to the point of BEP, where it becomes 0, and when it crosses, it falls on the loss zone. And if the market moves upward, same trend, same result you will see. That is, when the spot price becomes 3,200, the profit comes down to 135 from 235. When the spot price becomes 3,300, the profit will be 35. And when 3,335, break-even point reached. And when it crosses 3,400, then loss start minus 65. When it comes to 3,500, it becomes 165 loss. Now come long strangle. When a trader buys one OTM call, that is strike price is higher than the stock price, and one OTM put having strike price is lower than the spot price, and for the same maturity, the strategy is known as long strangle strategy. Here, the trader will incur a maximum loss when underlying price moves from one strike price to other strike price and remains within this range. That is, the spot price hovered between this range. The maximum loss will be the summation of two premiums when the market breaks it either to bullish side or bearish side. The recovery of losses will be started continuously up to BEP, where it comes to 0, and after that the trader will earn profit which may be unlimited. A long strangle cost is less because the strike prices are out of the money OTM, but requires a larger move in the stock prices or volatility to realize profit which may be unlimited. Now, the long strangle cost is less because the strike price are out of the money, where in the long straddle, the cost is higher because the strike price is ATM at the money, where premium is higher than the OTM out of the money. So, in comparison of strangle cost with the straddle cost, the strangle cost is less than the straddle cost. If the asset price moves significantly from the strike price in either side, that is in bullish side or bearish side, the trader can profit from the option which becomes in the money, while other option expires worthless. There are two BEP. One is lower BEP, that is equal to lower strike price minus total premium paid, and other is higher BEP, which is higher strike price plus total premium paid. Come to the table. Come to the diagram. Long strangle spot price is 3,000. Now buy one put option, strike price is 2,900. It is OTM because it is less than the spot price. Premium payable is 110. And buy one OTM call option, strike price is 3,100. Premium payable is 125. Total premium payable is rupees 235. Maximum loss is 235, and here you see the diagram, the same replica. It is the loss side which varies from this, which is fixed in this region, that is 2,900 to 3,100. When spot price hover in between this range, then the trader will experience a maximum loss of 235. Higher break-even point is higher strike price plus premium total payable is equal to 3,335, and lower is 2,665. Come to the table. you see the same thing. The maximum loss will remain same in the region of 2900 to 3100, and when it comes down, market comes down or market goes up, the loss will gradually reduce up to the point BEP, and after that they reach the profit zone. Today I stop the class here. Next day I will discuss the butterfly spread long and short. Thank you.